Hey, what's up, guys? Welcome to Houston Business Podcast. My name is James J. I am your host, and we are back for another Q&A with James J. I get questions asked throughout the week, and I just decided I'm going to just start putting the show together and answer the questions because usually if one or two or three people have a question, a lot of people may have the same question. So that is why we are here live tonight doing the show. If you have questions for me, please send me a DM. If I can't get to your question tonight, I will either answer your question via DM or I'll answer it during the show. We do this every Wednesday. I'm start doing every Wednesday at 7. So I've got some really good questions. There's been a lot going on this past week in the mortgage world. One of the things I want to address before we get into the Q&A, forbearances are one of the big hot topics in the mortgage industry right now. So the good news is if you put your home in forbearance and it's just say it's a 90-day forbearance, at month 4, you can renegotiate, maybe do a deferment or some other modification to your loan at that point, as opposed to you having to pay all 3 payments plus that 4th payment. So a lot of people were concerned about that. That has been rectified. But you do need to speak with your lender specifically, right? Every lender may be a little different in how they handle it. So you want to make sure you reach out to the lender if you're wondering how that would work. The other good news is for a mortgage company like our mortgage company or various mortgage companies, in a nutshell, we take mortgages, we close on them, and usually they get sold off to either Fannie Mae or Freddie Mac, which are government entities. I'll just leave it at that. Well, the government entities, Fannie Mae and Freddie Mac, were having an issue purchasing loans from mortgage companies where they purchase them and then that loan goes into a forbearance within about a couple weeks. All right. So Fannie Mae Freddie Mac said a few weeks ago, if the loan goes into forbearance within a couple weeks, well, hey, Mr. Mortgage Company, you're going to take this loan back. Right. So obviously, if I am a mortgage company, I don't want to take the loan back. Like, we sell the loans off so then we can go and lend money again. So that's the short version of what happens in the mortgage industry for most mortgage companies. We do the loan, we close, we sell it to Fannie Mae or Freddie Mac, then we can go lend money again. And then they continue to buy them, and then they put those loans into what they call a mortgage-backed security, which is essentially it's an investment. And then investors are paid from their investment, essentially. So that's a short version of how mortgage-backed securities work and how the mortgage industry, that's the very, very quick Cliff Note version of what happens. So, but anyway, good news is Fannie Mae, Freddie Mac have addressed this issue with mortgage companies like our mortgage company and various other mortgage companies throughout the country. This is not specific to our mortgage company by any means. This is just in general. They have fixed that issue with servicers. The other thing that you want to keep in mind is that when you go into forbearance, the loan servicer is still required to make payments. So although you're not making a payment, the servicer or the lender still has to make that payment. And so the servicers are throwing their hands up like, hey, how long do you think we can do this? And the government stepped in and said, you know what? After the forbearance is over, whether it's 3 months or 4 months or however long it is, we're going to step in and then we will continue to make these payments on behalf of the homeowner until they kind of get back on their feet or once that forbearance ends. So you can't forbear your payment forever, guys. At some point, you got to fix the situation either through a modification, a deferment, or you got to pony up whatever you deferred, 3 months, 4 months, 5 months, however long that is. So there's really no other option at this point. So, all right, got that out of the way. That has come up a lot this week, so I wanted to address it. So question number 1, which is a great question, pre-approval versus prequalification. This is a great question. All right. So the biggest difference is documentation. All right. So people get pre-qualified all the time and then don't get approved for a mortgage. Why? Because borrower A says, hey, I make $100,000 a year on their application. All right. At that point, I don't have any documentation. I'm just going by what they say they make. We pull credit Credit looks great based on credit, based on income. We come up with the debt to income ratio, and that is what a pre-qualification is. Based on those numbers, we say, here you go, you pre-qualify for $200,000. Now, you take that pre-qualification, you go shopping. This does happen, which is why I like to get documentation if I can at all. At least if it's a W-2 employee, I feel a little bit more confident. Most lenders will. Every situation is different. So it kind of depends on the situation. If you tell me you're self-employed, I'm not giving you a pre-qualification letter until I get documentation. All right. Self-employed people do things with their taxes and things we really got to address before I go putting my reputation on the line and giving you a pre-qualification letter. All right. Or pre-approval letter at that point. The biggest difference, again, pre-qualification, pre-approval. So pre-qualification, you said you make this. I pull credit. We look at it. Everything looks great. Pre-approve is, hey, borrower A, I need your pay stubs. I need your tax returns. I need some documentation to back up what you said you made on paper, right? Well, now I look at tax returns. I see this person has a side business and they decided to write off a bunch of stuff, right? Well, guess what? We are going to have to use what you put on your tax return as your income. That's what we have to go by. There's certain things that we can add back in to adjust your income up. But if you write off a bunch of stuff, you've kind of shot yourself in the foot when it comes to purchasing a home. So then we've got to look at other options. We've got to look at setting a game plan in motion for you to be able to get that qualification, pre-approval down the road, maybe it's a month, 3 months, 6 months, whatever the case may be. So pre-qualification happens all the time. Pre-approval, that's what you really want. You really want a pre-approval. And again, situations are different. If you're a W-2 employee, you've been on your job for years, a pay stub is probably going to suffice, assuming you don't have any other side businesses and things like that. So that was a great question. The other thing, second question was, what is private mortgage insurance? What is mortgage insurance premium? All right, it's the same thing, guys, same thing. It just depends on whether it's a conventional loan or an FHA loan. All right, essentially that mortgage insurance is there to protect the lender. All right, it is not your homeowner's insurance, not at all. It's not your homeowner's insurance. It's an insurance that you pay to the lender to protect the lender in the event that that loan is defaulted on. So you miss payments, if it goes into default, that insurance protects the lender. So private mortgage insurance premium is the same thing, different terminology. It's the same thing. It's to protect the lender. It is not your homeowner's insurance, completely different. Homeowner's insurance is to protect you and your asset. Mortgage insurance is to protect the lender. So great question there. Let's see. This is another question that came up. How many lenders should I talk to? This is a tricky question because honestly, I think I do the best job of any lender. I don't care who it is. So to me, I'm thinking you talk to anybody else. But what the reality is, you got all these online lenders. You've got a ton of marketing that some of these online lenders do. They spend a ton of money to market to consumers. And so the perception is that they're better. And the reality is most of the time they're not. So to me, if it's not a local lender, I always highly recommend stay local, even if it's not through us. And, listen, if you get a couple different estimates, just so you feel like everybody's at least somewhere in the same ballpark, I get it. But for me, I don't play around when it comes to my clients. I give them the best thing I can. There's no, hey, I'm going to give you this now and then kind of save something for later. Are there exceptions that I could try and get approved for my clients? Absolutely. And I try and do that when I can. And it just depends on the situation. What are we trying to do? What's your goal? But, as a loan officer, we don't get paid any different to have a certain rate. Like back in the old days, that used to happen. It doesn't happen anymore. So I have no reason not to give my clients everything up front that I could possibly give them. And sometimes, sometimes if we get some crazy quote from another lender, sometimes we can do some things to maybe compete a little bit more, so to speak. But I don't hold anything back, essentially, is what I'm trying to say. So that's it, guys. Those are the 3 questions. I'm only going to do about three, 4 questions This is a very short 10 minutes. I will do this every single Wednesday. But again, DM me your questions here or on Instagram at James J Mortgage on Instagram. Send me a DM here on Facebook. If you have any other questions, shoot me a DM. I'm looking forward to seeing you guys next week, and have a great week, guys. Talk to you next week.